Index funds seem like the golden child of investing. They're praised by experts, recommended by financial advisors, and make up nearly 45% of the US stock market. It's easy to see why so many people are drawn to them. They're simple, low cost, and offer instant diversification. But here's something you might not know. The growing dominance of index funds could actually be creating hidden problems. In 2023 alone, over $5 trillion flowed into index funds, but few investors stop to question why they're pushed so hard. Is it really because they're the best choice for everyone? Or could there be other reasons behind the scenes that we're not being told about? The truth is, Wall Street, big institutions, and even financial advisors have their own reasons for promoting index funds. And it's not always in your best interest. In this video, we're diving into the real reason index funds dominate, and it's not just about lower fees or ease of use. We'll explore the hidden costs, the passive investing paradox, and how index funds could be driving market bubbles. Plus, we'll uncover how this creates unique opportunities for value investors like you. Stay tuned as we break down the truth behind the index fund craze. Chapter 1. The Silent Giants. Why index funds dominate the market. Index funds have grown into silent giants in the world of investing. You hear about them everywhere, on TV, in finance blogs, even from your financial advisor. But why are they so popular? The reason is simple. Index funds offer a low-cost, hands-off way to invest. They track broad market indexes like the S&P 500, providing exposure to hundreds of companies in one easy package. Vanguard, one of the largest index fund providers, manages over $7 trillion in assets. This is proof of how powerful these funds have become. They're not just big, they're massive. Some experts believe that this has created a sort of feedback loop. As more people buy into index funds, the stocks in the index rise, which then attracts even more money into these funds. Warren Buffett famously said, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. That's a powerful endorsement, but it's important to understand why that's the case. Index funds aren't necessarily smarter, they're just simple and cheap. And for most investors, that's enough. However, the dominance of index funds comes with a catch. As they grow larger, they have a bigger influence on market movements. About 45% of the US stock market is now held in index funds. This means when the market moves, it's not because of individual stock performance, it's because massive amounts of money are flowing in and out of these funds. For value investors, this dominance of index funds presents opportunities. When a stock falls out of favor and gets pushed down in price due to index fund movements, it may still hold intrinsic value. That's where the value investor can step in and scoop up a deal. In the end, index funds dominate because they're easy, cheap, and effective for most people. But as a value investor, you can profit from understanding their limitations. Chapter 2. The Fee Illusion. Are index funds really the cheapest option? Index funds are often praised for being low cost. And it's true, most index funds have expense ratios well below 0.10%. But here's the catch. Low expense ratios don't always mean they're the cheapest option for everyone. First, consider hidden fees. Many investors don't realize that they're also paying trading costs, especially in periods of high market volatility. Even though you might only see a 0.05% expense ratio on paper, other costs like bid-ask spreads and taxes can add up. In some cases, these hidden costs can make index funds more expensive than they seem. A 2018 study from the Financial Analysts Journal found that hidden transaction costs in index funds could take as much as 0.30% off your return each year. That's 3 times more than the advertised expense ratio. For value investors, who typically hold individual stocks for longer periods, these hidden costs don't play as big a role. If you're investing in undervalued companies, you're less likely to be churning your portfolio. In contrast, index funds are constantly buying and selling stocks to match their benchmarks. That trading can eat into your returns. Then there's the issue of tracking error. Index funds don't always perfectly track the performance of the index they aim to mimic. Small differences in the way funds are managed can lead to a lower return than you might expect. For example, during the 2020 market crash, some index funds underperformed their benchmarks by as much as 0.50%. On the surface, index funds appear cheap. But if you look closer, the fee illusion can cost you more than you think. As a value investor, focusing on buying strong individual companies at discounted prices may give you a better return, without all the hidden costs. Chapter 3. Wall Street's Hidden Agenda. Why advisors love index funds. Ever wonder why your financial advisor keeps pushing index funds? It's not always because they're the best choice for you. In fact, financial advisors often recommend index funds because they're easier to manage and reduce their own risk of being blamed if things go wrong. The truth is, many financial advisors are incentivized to promote index funds. These funds are easy to sell to clients because they have a proven track record and a strong, set it and forget it, appeal. Advisors don't have to worry about picking individual stocks or watching the market closely, which reduces their workload. In addition, some financial institutions offer kickbacks for recommending their own index funds. It's a win-win for the advisor and the institution, but not necessarily for you. A 2017 study by Morningstar found that 75% of advisors recommend index funds from companies they are financially tied to. Here's something else to consider. Index funds are great for advisors because they provide built-in diversification. If one stock in the index performs poorly, it's balanced out by other stocks. This reduces the risk for both the advisor and the client. But while that sounds good, it can also mean missing out on bigger opportunities. Value investors know that diversification doesn't always lead to better returns. If you're buying the entire market through an index fund, you're also buying overvalued companies alongside the undervalued ones. This dilutes your potential gains. Legendary investor Charlie Munger once said, "The idea of excessive diversification is madness." In short, Wall Street loves index funds because they're safe and easy to sell. But as a value investor, you might be better off picking and choosing your own stocks based on intrinsic value. After all, it's the undervalued gems, not the entire market, that offer the biggest rewards. If you're finding this information useful, don't forget to subscribe for more insights on value investing and financial strategies. Chapter 4. The Passive Paradox. Are index funds creating market bubbles? The rise of index funds has led to a growing concern. Are they contributing to market bubbles? It's a question many investors are starting to ask. When everyone is piling money into the same stocks without considering their actual value, it's easy to see how prices can get inflated. Here's the paradox. Index funds are supposed to be passive, but they're having a massive impact on the market. By tracking an index, they buy more of the stocks that are already doing well, pushing their prices even higher. This can create a situation where certain stocks become overvalued, simply because they're included in an index. A 2020 study by the National Bureau of Economic Research found that stocks in popular indexes tend to trade at higher price-to-earnings ratios than those outside of indexes. This isn't because the companies are performing better, it's because they're part of a fund that everyone is buying. Take Tesla, for example. When it was added to the S&P 500 in late 2020, its stock price surged. But did the company's fundamentals change overnight? Not really. It was mostly due to index funds buying up Tesla shares to match the index. For value investors, this creates an opportunity. When index funds push prices higher without regard for value, it can create inefficiencies in the market. Stocks that aren't part of major indexes might be overlooked, even if they're undervalued. Legendary value investor Benjamin Graham once said, "The stock market is a voting machine in the short term, but a weighing machine in the long term." Right now, index funds are controlling the votes. But eventually, the market will weigh the true value of companies, and that's when value investors can benefit. While everyone else is blindly following the herd, value investors can take advantage of market inefficiencies and find undervalued gems that are being ignored. Chapter 5. The Missing Piece. Why index funds ignore value opportunities. One of the biggest drawbacks of index funds is that they ignore individual stock performance. Instead of looking for undervalued opportunities, they buy every stock in an index, regardless of price. This is a huge missed opportunity for value investors. Value investing is all about finding stocks that are trading for less than their intrinsic value. Index funds don't do this. They don't care whether a stock is overvalued or undervalued, they just buy it because it's part of the index. As a result, many great opportunities are overlooked. Warren Buffett has often said, "Price is what you pay, value is what you get." With index funds, you're paying for both good and bad stocks, without regard for what they're really worth. But if you're a value investor, you know that you can find better returns by focusing on individual stocks that are trading at a discount to their true value. A study by MSCI showed that during times of market volatility, active value strategies often outperform passive index strategies. This is because value investors are able to take advantage of market mispricing, while index funds are stuck holding whatever is in the index. Let's look at a real-world example. In the 2008 financial crisis, many index funds were forced to hold onto struggling financial stocks. But savvy value investors, like Buffett, were able to find great deals in companies that were temporarily undervalued. By focusing on individual stock performance, value investors can make smart, targeted decisions that lead to higher returns. Index funds may offer diversification, but they miss out on the opportunity to capitalize on market inefficiencies. For value investors, this is the missing piece that makes all the difference. If you enjoyed this video and want to learn more about value investing strategies, subscribe for more tips and insights.